Something strange was happening across Britain's housing market. Estate agents were sitting in empty offices, staring at phones that wouldn't ring. Buyers who had been actively searching for months were suddenly backing away from deals they'd been desperate to close just weeks earlier. Contracts sat unsigned on desks. Viewings were being cancelled. The entire property sales machine that had been chugging along despite economic uncertainty was grinding to an abrupt halt. It wasn't a crash. It was something more unnerving. It was paralysis. Whispers were spreading through the market like wildfire. Something big was coming. The budget announcement scheduled for November 26th had everyone spooked. Rumours circulated about massive property tax changes, capital gains hikes that would hammer sellers, and stamp duty reforms that could upend decades of market practice. Nobody knew exactly what was coming, but everyone was convinced it would be brutal. So they waited. Foxtons reported activity so subdued it felt like the market had collectively decided to hold its breath. Buyers refused to commit. Sellers pulled back. The industry watched the calendar tick toward budget day with a mixture of dread and fascination. But if you enjoyed this video so far, make sure you hit that like button and subscribe to Property Reporter so you never miss the latest UK property, economy and housing news that could affect your financial future. Then November 26th arrived and everything changed. Overnight, the budget was announced and within hours, something remarkable happened. Knight Frank's offices, which had been eerily quiet for weeks, were suddenly swamped. Phones started ringing off the hook. Buyers who had vanished reappeared ready to move. The same people who wouldn't even return calls a week earlier were now pushing to close deals immediately. Weekly sales figures that had been dragging along the bottom suddenly surged upward in a dramatic spike that caught even seasoned agents off guard. What had changed? The fear evaporated the moment the actual budget details emerged. The catastrophic property tax changes everyone had been dreading either didn't materialise or weren't as severe as the rumours suggested. The uncertainty that had frozen the market solid melted away in a single day. Buyers realised they'd been spooked by shadows and speculation. The pent-up demand that had been building through October suddenly released all at once. Contracts that had been sitting unsigned for weeks were suddenly being rushed through. Properties that had languished with no interest were getting multiple offers within days. The market didn't just recover, it rebounded with force. But the official numbers told a more complicated story than the dramatic reversal at places like Knight Frank suggested. HMRC transaction data painted a picture that was neither collapse nor boom, but something more nuanced. Yes, there was resilience. Yes, certain segments bounced back. But dig deeper, and cracks started showing. Regional variations were stark and getting starker. London was operating in a completely different reality than the rest of the country. High-end properties in the capital were moving. Wealthy buyers had ridden out the uncertainty with barely a pause. But in the Midlands, in the North, in smaller cities and towns, the picture looked nothing like the rosy rebound narrative. Transaction volumes in some areas remained stubbornly flat. Properties sat on the marr, kept longer. Price reductions were becoming more common. The word resilience was being thrown around in market reports, but it was masking underlying fragility. The gap between winners and losers was widening into a chasm. What looked like a healthy market recovery from 30,000 feet up started looking like a bifurcated market when you got closer. Two different housing markets were emerging in the same country, and that divergence was accelerating. While everyone was focused on sales and buyer confidence, something far more significant was approaching with barely any attention. May 2026. That's when the Renters' Rights Act would fundamentally transform England's rental market. The centrepiece was clear: no fault evictions would be banned. After decades of landlords being able to evict tenants with just 2 months' notice and no reason given, that power would vanish. A new ombudsman system would be established to handle disputes, giving renters a formal avenue to challenge unfair treatment. On paper, it looked like a revolution for the 4.6 million households living in England's private rental sector. Protections that tenant advocacy groups had fought for years to secure were finally becoming law. The narrative was clear. Renters were finally getting the security and rights they deserved. Landlords would finally be held accountable. The Wild West days of Britain's rental market were coming to an end. It sounded transformative. It sounded like justice. But there was a problem lurking beneath all the optimistic rhetoric, and it was massive. The enforcement statistics were absolutely damning. 2/3 of councils across England hadn't prosecuted a single landlord in the previous 3 years. Not one. Despite countless complaints about illegal evictions, unsafe conditions, harassment, and violations of existing tenant protections, the vast majority of local authorities had taken zero legal action. The numbers got worse the deeper you looked. Of all the complaints filed by renters, only 2% resulted in any meaningful action whatsoever. 98% of people who reported problems to authorities saw nothing happen. No fines, no prosecutions, no consequences for landlords who broke the rules. Across the entire country over 3 years, only 16 landlord bans had been recorded. 16. In a rental sector with hundreds of thousands of landlords and millions of tenants. Rogue landlords were operating with virtual impunity, and everyone in the industry knew it. The new Renters' Rights Act was promising accountability and protection, but what good were new laws when existing laws weren't being enforced? What good was banning no-fault evictions when illegal evictions already happened regularly with no consequences? The gap between what the law said on paper and what actually happened in practice was enormous, and nothing in the new legislation addressed the fundamental enforcement problem. Meanwhile, landlords weren't waiting around to see how things played out. A quiet exodus had already begun. Small landlords, the ones with 1 or 2 properties who'd built modest portfolios over years, were selling up. The calculations had changed. Mortgage interest tax relief had already been stripped away in previous years. Potential capital gains tax increases were looming. Energy efficiency requirements were getting stricter and more expensive. And now the Renters' Rights Act was removing their ability to regain possession of their property, without going through lengthy and costly legal processes. For many, it simply wasn't worth it anymore. Property portfolios were being quietly liquidated. Listings were going up. Buy-to-let mortgages were being paid off. The data was starting to show it. Landlord associations were reporting members leaving the sector in significant numbers. The unintended consequence was obvious, but somehow not being discussed in policy circles. The rental market was shrinking. Fewer landlords meant fewer rental properties available. Supply was contracting just as demand continued to rise. Renters were about to find themselves in a cruel paradox. The very protections designed to help them were contributing to a supply crisis that would make their lives harder. New tenant rights were arriving in May 2026, but the number of available rental properties was dropping month by month. Simple economics kicked in. Less supply, same or higher demand, prices go up. Rental prices were already climbing in anticipation. Landlords who were staying in the market were becoming more selective, knowing they'd have less flexibility to remove problem tenants. Competition for remaining properties was intensifying. Stories were emerging of dozens of people showing up to single viewings, offering to pay months of rent up front just to secure a place. The irony was brutal. Laws meant to give renters more security and protection were coinciding with a market that was becoming harder to access and more expensive. First-time renters and those with any kind of blemish on their record were being frozen out entirely. The rental crisis that already existed was about to get significantly worse, and it was happening in plain sight with minimal media attention or policy response. So what does all this mean for 2026? 3 massive forces are colliding simultaneously, and the impact is going to be significant. Buyer confidence in the sales market is recovering but fragile, dependent on continued economic stability and no further policy surprises. Sellers remain cautious, particularly landlords who are trying to time their exits to maximize returns before potential tax changes hit. And the rental crisis is building into something that could genuinely destabilize the lower end of the housing market. Regional divergence is accelerating. London and the South East will likely continue operating in their own reality, insulated by wealth and international demand. But the Midlands, the North, and smaller cities face a much more uncertain picture. Transaction volumes could remain suppressed. Prices could stagnate or decline in some areas. The rental shortage could push more people toward ownership before they're financially ready, creating a new generation of stretched buyers vulnerable to interest rate increases. Who wins in this landscape? Cash buyers. wealthy investors who can weather uncertainty, landlords with large portfolios who can absorb regulatory costs, people already on the property ladder in desirable areas. Who loses? First-time buyers competing in a market with limited stock, renters facing a shrinking pool of available properties and rising costs, small landlords being squeezed out by regulation and taxation, anyone trying to move in regional markets where activity has stalled. The decisions people make right now matter more than usual. Buyers need to look beyond headline recovery stories and understand their specific local market. Renters should be locking in longer tenancies now before the supply crunch really bites. Landlords need to decide whether they're committed for the long term or getting out while they still can. Because 2026 isn't going to be a gentle year for UK property. Multiple structural changes are hitting at once. Enforcement of new rules remains questionable, and the gap between different market segments is wider than it's been in decades. The market isn't crashing, but it's definitely fracturing, and understanding which fragment you're in could make all the difference to your financial future.